How would your life change if you never had to worry about money again? If you could pursue your passions, travel the world, or simply spend more time with your loved ones, all while your wealth continued to grow? That's the kind of freedom the dividend snowball can provide, and it's not as complicated as you might think. Welcome to MoneyWise Investor, your trusted source for financial information. In this video, we're going to break down exactly how the dividend snowball works, where to invest your money for maximum impact, and how much you could potentially earn. You see, most people have it all wrong when it comes to investing. They're chasing the next hot stock, trying to time the market, or worse, keeping their money in a savings account that's barely keeping up with inflation. But the real secret to building lasting wealth is all about harnessing the power of compound interest and dividend growth. Think of it this way. You're standing at the top of a snowy hill, holding a tiny snowball in your hand. As you roll it down the hill, it starts to pick up more and more snow. At first, the growth is slow, barely noticeable, but as the snowball gets bigger, it starts to pick up more and more snow with each rotation. Before you know it, that tiny snowball has turned into a massive boulder, unstoppable in its momentum. That's exactly how the dividend snowball works. You start small, investing in quality companies that pay reliable dividends. At first, those dividend payments might seem insignificant, a few dollars here, a few dollars there. But here's where the magic happens. You reinvest those dividends, buying more shares, which in turn generate more dividends. And the cycle continues with your dividends and your investment growing bigger and bigger over time. Let's break this down into two main strategies. Strategy number 1, one-time investment. This is for those of you who might have a lump sum to invest, maybe from a bonus, an inheritance, or savings you've built up. Here's how it could play out. Let's say you invest $10,000 in a dividend stock that yields 4% annually and grows its dividend by 7% each year. In the first year, you'd earn $400 in dividends. Not bad, right? But here's where it gets exciting. If you reinvest those dividends and the stock price grows at a modest 5% per year, after 10 years, your initial $10,000 could turn into over $23,000, and you'd be earning nearly $1,000 in dividends that year alone. Fast forward to 20 years, and you could be looking at an investment worth over $66,000, generating $2,600 in annual dividends. That's the power of the dividend snowball in action. Your initial $10,000 is now earning more in dividends each year than you originally invested. Strategy 2, monthly investment. But what if you don't have a big lump sum to invest? No worries. The monthly investment strategy can be just as powerful, if not more so. Let's say you decide to invest $500 every month into dividend-paying stocks or funds, using the same assumptions as before: 4% dividend yield, 7% dividend growth, and 5% stock price growth. Here's what could happen. After 10 years, you'd have invested a total of $60,000, but your portfolio could be worth over $86,000, and you'd be earning about $3,400 in annual dividends. Not too shabby. But it gets even better. Keep this up for 20 years, and your portfolio could grow to over $270,000, generating nearly $11,000 in annual dividends. That's almost $1,000 a month in passive income. The beauty of this strategy is that it's accessible to almost everyone. You're not trying to time the market or make risky bets. You're steadily building your snowball, month after month, letting compound interest work its magic. So which strategy is better? Honestly, the best approach is often a combination of both. If you have a lump sum to invest, then set up regular monthly investments to keep building your snowball. The key is to start as soon as possible and be consistent. Now that you understand how the dividend snowball effect works, you're probably wondering, where should I invest my money to make this happen? Great question. Let's dive into 3 powerful options that can supercharge your dividend snowball. First up, we have dividend aristocrats. Sounds fancy, right? Well, these stocks are the cream of the crop when it comes to reliable dividend payers. So what exactly is a dividend aristocrat? It's a company that is part of the S&P 500 and has increased its dividend payout every single year for at least 25 years straight. We're talking about companies like Johnson & Johnson, Coca-Cola, and Procter & Gamble. These are rock-solid businesses that have proven they can weather economic storms and still reward their shareholders. Why are dividend aristocrats so great for your snowball? For starters, they offer stability. These companies have shown that they're committed to growing their dividends year after year. This means your income stream isn't just steady, it's growing. Plus, many of these companies are household names with strong market positions, which can mean less volatility in your portfolio. But here's a pro tip. While dividend aristocrats are fantastic, don't put all your eggs in one basket. Diversification is key, which brings us to our next option, high dividend ETFs. High dividend ETFs are like the Swiss Army knives of dividend investing. ETF stands for Exchange Traded Fund, and they are a collection of dividend-paying stocks all wrapped up in one neat package. The beauty of high dividend ETFs is that they give you instant diversification. Instead of buying individual stocks, you're getting a slice of dozens or even hundreds of dividend-paying companies. This spreads out your risk and can lead to more stable returns over time. Some popular high dividend ETFs include the Vanguard High Dividend Yield ETF or the SPDR S&P Dividend ETF. These funds focus on companies with above-average dividend yields, which can really fuel your dividend snowball. Another advantage of ETFs is their low costs. Many have very low expense ratios, which means more of your money stays invested and working for you. But wait, there's more. Our third option brings a touch of real estate to your dividend portfolio, REITs. REIT stands for Real Estate Investment Trusts. These are companies that own, operate, or finance income-generating real estate. The cool thing about REITs is that they're required by law to pay out at least 90% of their taxable income as dividends to shareholders. That's right. It's literally in their DNA to shower you with dividends. REITs can be a great addition to your dividend snowball for a few reasons. First, they offer higher yields than many traditional stocks. We're talking yields that can sometimes be in the 4 to 6% range or even higher. Second, REITs give you exposure to the real estate market without the headaches of being a landlord. No midnight calls about broken pipes or dealing with difficult tenants. You get the benefits of real estate income without the hassles. Lastly, REITs can provide good diversification for your portfolio. Real estate often moves differently from the stock market, which can help smooth out your overall returns. Some popular REITs to look into include Realty Income, which is actually nicknamed the Monthly Dividend Company, and Digital Realty Trust, which focuses on data centers, a growing sector in our increasingly digital world. Now you might be wondering, how do I choose between these options? Well, the truth is you don't have to. A well-rounded dividend portfolio often includes a mix of all three. Individual dividend aristocrats for stability and growth, high dividend ETFs for diversification and yield, and REITs for higher income and real estate exposure. The key is to find the right balance that fits your goals and risk tolerance. All right, now that we've covered where to invest, let's get to the exciting part. The potential returns for an ideal dividend portfolio. Let's start with the one-time investment strategy. Imagine you've got $50,000 to kickstart your dividend snowball. You decide to create a balanced portfolio. 40% in dividend aristocrats, 40% in high dividend ETF, 20% in REITs. Now let's make some assumptions. We'll say this portfolio yields an average of 4% in dividends annually. The dividends grow by 6% each year, and the stock prices appreciate by 5% annually. Remember, these are just examples. Actual returns can vary. Here's how your investment could grow. After 5 years, your initial $50,000 could grow to about $69,000. You'd be earning about $2,760 in annual dividends. After 10 years, your portfolio could be worth around $102,000. Annual dividends could reach $4,080. After 20 years, your investment could balloon to about $227,000. You could be earning a whopping $9,080 in dividends each year. That's the power of dividend snowball in action. Your initial $50,000 investment could be generating over $9,000 in passive income each year after 2 decades. And remember, this is assuming you never add another cent to your initial investment. But what if you don't have a large lump sum to invest? No problem. Let's look at the monthly investment strategy. Say you decide to invest $1,000 every month into the same balanced portfolio we described earlier. Here's how it could play out. After 5 years, you'd have invested a total of $60,000. Your portfolio could be worth about $71,000. You'd be earning about $2,840 in annual dividends. Total invested, $120,000. Portfolio value, about $173,000. Annual dividends, around $6,920. After 20 years, total invested, $240,000. Portfolio value could reach $580,000. Annual dividends, potentially $23,200. Now we're talking. After 20 years of consistent monthly investments, you could have a portfolio generating $23,000 in annual dividends. That's nearly $2,000 a month in passive income. Now you might be thinking, these numbers sound great, But how realistic are they? It's a fair question. While these examples are based on reasonable assumptions, it's important to remember that investing always carries risks. Stock prices can go down as well as up, and dividends can be cut or eliminated. That's why diversification is so important. By spreading your investment across different companies and sectors, you're reducing the impact of any single stock performing poorly. It's also crucial to reinvest your dividends, especially in the early stages. This is what really turbocharges your snowball effect. As your dividend income grows, you can start to take some cash flow while still reinvesting the rest to keep your snowball going. And hey, if you found value in this video, why not help out your fellow investors? Hit that like button and share this video with anyone you think could benefit from learning about the dividend snowball effect. Don't forget to subscribe and turn on notifications so you never miss out on our latest money-making strategies. Thanks for watching, and until next time, stay money-wise.